Okay, let's call the JRIB meeting to order. What time is it? 8:09. I apologize, by the way, to everybody. We had a longer than expected executive session. Involves the whole pension, not just the P&F, so. Why don't we see if someone wants to approve the minutes from the August 27th meeting?
So moved.
I'll second the motion.
Okay, thank you. Any comments? I have two very small ones, Calvin. One is, it describes me as vice chair. Should be chair, I guess. That's about 2/3 of the way down, first page. And then at the bottom, you just spelled JRIB, RJIB, right? It says Joshua Barbash of BlackRock led the RJIB, which is a new group as far as I can. That's the only two things I saw. Anybody else have any other things they identified? No?
No. What do I do? I make a motion to accept the amendments?
Please? Second?
Second.
Okay. All in favor?
All right.
Opposed? Blah, blah, blah. No? Okay. Do I hear a motion to accept the amended, the minutes as amended?
So move. Second?
Okay, Nick? All in favor?
Aye.
Aye. Opposed? Abstained? Okay. Excellent, so that's done. And let's see, sorry. Okay, so I think that takes care of the housekeeping. So we have two, really one big issue tonight, right? We always have a performance review, and I'm gonna recommend to our esteemed BlackRock folk to keep that to an absolute minimum, given that we're starting late and we all know how great the markets have been. And we have some important stuff to talk about in terms of the portfolio allocations. So I'll turn it over to our friends from BlackRock, and appreciate your being here.
Yeah, it's great to see everybody. I will keep the performance part of this presentation relatively short. What we have in the deck, the first maybe 15 or 20 pages or so, is the August flash report. Our September report, or at least performance, officially released earlier this week. So not part of this package, but I'll speak to September positioning, or at least where assets are as well, where I can. And maybe we'll just, I know we have that exec summary at the start, but maybe we'll just flip to page 6 to cover pension, and then we can cover the OPEB. In terms of the asset allocation, no real significant changes from target allocations that you can see on the top left. Portfolio NAV as of the end of August at 515 million. The update is as of the end of September, that stood at a little over 525 million. And as of close yesterday, the pension assets stood at 530.4 million. So continuing to see resilient equity markets, equities rallying. We're starting to see Q3 earnings roll in a bit stronger. Obviously, most of the market has not reported yet, but we're seeing an upswing on earnings beats. If that pace continues, this would be the best quarter in a while in terms of earnings beats. Obviously, we've seen some big names miss with Netflix yesterday, and a couple other names missing. So it'll be something to watch for. A lot of the big tech announcing in the next 2 days. Yields have also rallied recently. It's been a downward trend in rates from May, really. But what we did see is that the resiliency of the market and the rally in rates, especially in that early October volatility that we saw, kind of good signs for fixed income still being a safe haven type asset. Volatility is, maybe elevated in some pockets, but markets are showing resilience, and we're kind of seeing through that volatility, which continues to track BlackRock's overall theme and trend that the near term macro is a bit clearer than especially we were if you think back to April with tariffs and uncertainty around there. So you're seeing, as tariff announcements or things come out, the volatility is less deep and much more short-lived. So we're still living through those immutable economic laws that we're not going to see rewiring of supply chains and all of these grand shifts in the macro environment. And that mega forces, right? The AI theme has been driving a lot of the equity performance, especially in the US. And that is going to, we think, continue to happen. So we've been living through it. In the positive side here, again, the pension assets up to 530.4 million. You look at the bottom of the page here, this is the performance. So fiscal year to date, this would be through end of August. The portfolio returned 2.5%. At the end of September, that total portfolio performance is 5.2%. So well on the way to the 6.9% kind of target return, again, driven September, really strong performance month. Your equity portfolio through the end of September is up a little over 7.5%. With fixed income up about 1.5%. We did get updated private markets through June 30th. So the performance package that's here, it was a little bit mixed at the end of August with the early Labor Day. We got most of the prints kind of the first week of September. So it's all included in the September 30th performance, but your private equity portfolio up about 4.25%. Fiscal year to date. So again, that 3-month lag dragging private equity, still dragging the public markets just a little bit. And, the alternatives portfolio as a whole for the fiscal year to date through the end of September is up about 4.4%. So strong positive performance across the board on pension portfolios. We can quickly walk through the underlying securities. Certainly as, you're passively invested, the liquid portfolio.
Hey, Josh.
Yep.
I'm sorry. Does anybody at the table have any specific questions about performance? I genuinely appreciate, I know your instinct is to give us a lot of info, but I just know you have a lot to work on here tonight, and I'm just not 100% sure we need to go granular, given how good things are.
No problem. I'll quickly just hit the OPEB on page 12. At the end of August, assets were 106 million. At the end of September, that asset value hits just a tick under 109. And as of close yesterday, you're at 109.8. So the performance for OPEB, at least fiscal year to date, again, a bit better than the pension portfolio because you're a bit higher allocation to equities. So the total portfolio for OPEB fiscal year to date through the end of September was 6.25. So again, really strong performance across the board, driven mostly by the equities, the fixed income positive, private markets also positive, with the private equity lagging some of the public markets a little bit, but strong performance. There's no questions on the rest of that performance. And Ken, for the Board of Finance meeting, the official September 30th report, we'll release that to you in the next week or so. So make sure that you get that.
Okay, thank you.
Okay, we'll turn to the business of the day on the asset allocation review. That is starting on page 17 of the materials, but page 18 is the roadmap. So we're now in the middle section of our roadmap. We had the risk workshop at our last summer meeting in August, where we went through and set some of the risk tolerances, thought about our objectives that we wanted to hit on and meet. And today's meeting, we'll discuss the SAA recommendations. The hope is...
Josh, I'm terribly sorry. Hey, Calvin?
Yes.
I just got a note from Tom Collymore. He says, I can't get in. And he wrote ID number 395-180-1920.
Maybe using the ID is 725
Okay, hang on a second. 725
068
068
2401.
2401
Right. Hash code is 123.
and 123. Okay. Go ahead, Josh. Okay, Josh.
All right, great. So I know we sent the material a couple of weeks ago for everyone to review. I'll do high-level summary on kind of objectives, tolerance, and some of the analysis. What I'll then do is we'll focus on the pension first, and we can walk through a bit more granularly in detail some of the exhibits rationale behind some of the portfolios. Obviously, if there's questions, comments as we go through this, please interrupt to ask questions. We'll also leave plenty of time for discussion amongst the JRIB. So on page 20, I'm sorry, on page 19, again, just the high level. And I think the bottom of the page is really what the highlights are. The risk workshop that I mentioned in August, we covered return objectives, we covered risk tolerance, and we talked about these things in the context of the time horizon. We want to make sure we all understand, we're managing assets for long dated liabilities. We're thinking about the long-term needs of funding benefit payments. Certainly short-term liquidity is something that we should take into account. But as we think about the return objective, that annual return, there's an incentive to make sure we have portfolios that are going to achieve that over the longer horizon. Obviously, our crystal ball, right? It's hard to exactly say what you're going to get 20 years from now, but the goal should be to make those returns, because consistently underachieving some of those returns, which is one of the risk tolerances that we have, is that underachieving or having a portfolio that doesn't generate enough return leads to higher costs further down the line. And some of the stochastic analysis that we did, especially around contributions, kind of emphasizes that in the near term, a lot of the portfolios may not have a lot of differences, but if we think long-term nature here, and missing some of those returns leads to less positive outcomes. So kind of focusing on that target return, making sure we're in portfolios that are generating the returns needed to earn that over a horizon. And while we think about annual volatility, some of that volatility and noise does get smoothed out as public pension valuations do smooth gains and losses over a long period of time. The contribution amortizations are thought of as amortizing over 15, 20-year horizons. That near-term drawdowns can be withstood if there's recoveries and longer recoveries. I know we can talk about when we look at some of the stress test analysis and some of the downside risks to some of the portfolios, certainly very poor markets over a long sustained period of time wouldn't be a great outcome. But we do think that the portfolios and the recommended portfolios do build in some resiliency around, shock scenarios, especially scenarios that we've witnessed over the last 15 or 20 years. So I just want to pause there. I just want to make sure we covered, the objectives, the return objectives, the risk tolerances, that everyone's comfortable that that's kind of the lens that we'll look at these portfolios, but also open to hear if there's any, views or opinions that haven't been covered or weren't covered in some of those comments.
I think you can move on.
Yep. Okay. Lots of words on 20. Thinking again, the high level, there were 4 options that we looked at in comparison to the current portfolio. And I think first, one of the takeaways that we should have is the current portfolio does a decent job for the pension funds and the OPEB assets, if we turn to the OPEB at some point, right? You're hitting the right required return over a long period of time. The expectation is there. Certainly over the last 3 years, the portfolio has generated well in excess of that 6.9% target return. So I would say that there's nothing wrong with the current portfolio. I think what we'll look at is moderate tweaks to the portfolio to try and see if there's ways to add some resiliency around just having pure equity, pure investment grade fixed income allocations. So in terms of the options that we looked at, option A would be all liquid if there was a desire to get out of all private market assets that you have. For the pension fund, the fully liquid, all public market portfolio does result in worse outcomes than all of the other portfolios that we looked at. Part of that is the return isn't high enough. The volatility is a bit higher. So in stress market scenarios, you see drawdowns that are worse within an all liquid portfolio. And so we would recommend not really considering that portfolio, but we wanted to include it for illustrative purposes. In terms of options B and C, this is where we're going to carve out an allocation to return-seeking fixed income assets. These would be high yield, emerging market debt, and bank loans. They have higher return properties than the core bonds that are in the portfolio. One of the benefits here is the way that you would fund the allocations to these return-seeking fixed incomes is part of it is going to come out of equities and part of it's going to come out of the fixed income. So you're able to increase some of the returns without reallocating directly into public market equities. Option D, we did not do full illustrations on, but we thought it would be good, at least from a portfolio return comparison analysis, is some of BlackRock's best strategic thinking, which is generally focused a bit more on the private market side. From the August workshop that we talked about, the liquidity needs, the near-term liquidity needs of the portfolio could support additional private market assets. But we don't think that additional private market assets would immediately mean everything is in private equity or real estate that you currently have. We do see market opportunities in both private infrastructure as well as private credit. When we look at the CMA slide in another page or two, you can see the risk return characteristics. They're both very diversifying from the current portfolio you have. And for both the pension and the OPEB, this option D does ultimately result in a better risk adjusted return. But I think we'll caveat with option D that potentially further education, especially on the private infrastructure opportunities, private credit opportunities, would probably be warranted for the board before making a decision to move in that direction. And so ultimately, we'll focus on comparing your current portfolio to both options B and C, which generally keep the private market allocation sizing the same, but is just reallocating assets both within the liquid portfolio to return-seeking fixed income and readjusting the private market assets within the context of the assets that you still have. So that was a very quick high-level summary for those that went through the material beforehand. I hope that summarizes what you read. And I'll pause for questions before we jump in. Okay.
I think you can continue. I think you did a good job outlining those four options, and I agree with you. It's good to have option D there because we should have as much information and choice as possible, but my instinct is B and C is where, I'm not instructing you or anybody on the table, but I think B and C where I think most of the board is going to probably want to spend most of our energy.
Yeah.
And especially because none of this is written in stone. I just want to make sure everybody at the table understands that we're looking at ways to massage or possibly try to improve our allocation. But it doesn't mean we have a one and done type of situation here. This is a constantly evolving process. So the more education and the more knowledge we have about what is available to us, I think the more comfortable, at least I'll be, making some sort of vote or decision. Anyway, so unless somebody else has any specific questions, we'll let you walk us through these options and a little bit of background and so forth.
Certainly. And then just quickly on 22, just to visualize, what the recommendation for some diversifying return-seeking fixed income would do for the portfolio. So if you look at the solid line across the page, that's the expected return target. That's the actuarial assumption that you use for both the pension and the OPEB funds. The red diamonds labeled pension and OPEB portfolios are the current expected return assumptions for those portfolios. So both portfolios, the current allocation, we do believe supports the current discount rate and the expected return assumption. We believe that it would out-earn those a majority of the time. And so this isn't a need to find a new portfolio because you can't support the return that you're assuming, or that the portfolios aren't achieving that return. Right? Remember, the last couple of years you've seen well in excess. Even now, through a quarter of the year, you're almost all the way to the 6.9% return for the year. So the portfolio has the right return assets. But what I'll highlight is there's the red circles, kind of your global equities, your equities that anchors the portfolio. And below this dash circle, there's a couple of pink dots for global fixed income, U.S. and international fixed income. So what you're doing right now is you're barbelling between those two key assets. You use private equity, which is all the way at the top right of the page, to help increase some of that expected return. But you're really barbelling between equities and those core fixed income, and where the dash line is. Equity return assumptions are not significantly higher than that 6.9% return. So what we can do is diversify between equities and fixed income, or the core fixed income, with these more return-seeking fixed income assets that have higher expected returns. So they're higher up on the page. They go vertical. They're a bit more volatile than core bonds. They're some of them have a little bit riskier credit exposure, right? Most of these are investment grade. High yield is more double B exposure, but ultimately they're additive from diversifying the exposures in the portfolio and provide a bit better return, which allows you to dial a little bit back. And as we look at the portfolio, it's about a 2% reduction in equities and a 7% reduction in the core fixed income to get you to that funding of those return-seeking fixed income. So keeping this visual in mind, let's jump into the SAA review. So focusing on the pension plan on page 24, again, the current portfolio, I'll keep coming back to, does an adequate job. Based on our simulations over 20 years, the portfolio is expected to grow from, at June, it was 490 million to 860 million over 20 years. That includes benefit payments coming out. It includes the town's contributions. But more importantly, the funded ratio grows over 100%. That's the goal, ultimately, is to fully fund the benefits. And following the median path, the green line, the current portfolio does achieve almost 120% funded at over 20 years, in line with kind of what your actuary is assuming you cross that 100% funded somewhere around 2040 or 2041. So still a number of years to get there, but the expectation is that you do get there. Certainly, there's downside risk where at the 25th percentile, assets aren't growing as quickly and the funded status stays relatively flat. But again, that's because the current expected return at 7.1 is just barely above that 6.9% expected return. So anything below that leads to kind of a stagnated funded status. So if we look at the focused portfolios and the illustration as a whole on page 25, going from left to right, the current target again is the first column. So again, that's where your 50% global equities, that's where your 35% in the core fixed income and 15% of your private markets, the 10 private equity and 5 core real estate. So again, to reiterate the portfolios that we looked at, option A, the second column, is all liquid. You would have to increase equities from 50 to almost 75%. We do increase we do add the return-seeking fixed income assets and your core fixed income, but all of your total fixed income is about 26% of your portfolio. But here your return drops, actually. It goes from 7.1 to 6.9, and the volatility increases pretty substantially.
Can I just interrupt you with one very, very obvious comment that, as I look around the table, I don't think is going to be a surprise to anybody because we have a fairly sophisticated group here, actually. When you say that's based on BlackRock's models and projections, it's not like it's a fact, right?
That's right.
Okay.
Yeah, based on capital market assumptions.
Understands that, okay? It's an important piece of information. People seem to think that these big firms have some sort of crystal ball type situation. They don't. What they do have is very smart people modeling current and future information and trying to come up with their best guesses as to what might happen going forward. So anyway, just to throw that out there. Otherwise, we would just take the highest return thing you have and go home, right?
Well, I mean, definitely, like I said, the crystal ball kind of trying to project out 30 years, these will obviously be moving targets over time. Mm-hmm. But I think generally, right, thinking about moving to an all liquid portfolio to support as high of an expected return of 6.9, certainly increases to equities would be warranted. And so that's probably the biggest risk with option A, is just taking on much more equity risk to achieve that return. So returning back to the portfolios that have this 15% target, and we'll have these as the focus portfolios, as options B and C. As I mentioned, to fund that return-seeking fixed income allocation of 10% of the portfolio, you're taking 3% out of global equities and 7% out of the core fixed income assets. So you're ending up with what is global market cap weight. That's how the equity allocation is weighted here. 47% to global equities, that 10% to return-seeking fixed income. So it's a blend of high yield debt. Again, this is corporate bonds that are not investment grade rated. Most of high yield bonds are still in the single and double B range. It's been a trend over the last 10 years or so, that there's still a lot of high quality companies issuing debt, but they're called sub IG or sub investment grade for that reason. There's the emerging market debt. That would be about 4%, and bank loans 2.5%. Bank loans tend to be floating rates, so there's no duration, so there's no sensitivity to changes in treasury rates. There's also been a substantial move over the last 10 or 15 years where bank loans are becoming a substantial part of how companies are accessing capital. And so it's just varieties of fixed income and bond assets that are not included in the US aggregate bonds that you currently own. So it's expanding the fixed income profile of the portfolio, and again, increasing that return. So on an expected return basis, despite dropping the global equity allocation by 3%, BlackRock's views are that this would be additive to expected return and increase the return by 20 basis points from 7.1 to 7.3%. And then finally, option C, where the private market allocation is moved from real estate, that 5% real estate allocation is allocated to private equity. You can see a further reduction in your public market equities, right? Certainly a reasonable, consideration here of the trade-off here is that, you're taking private equity allocations, and so you can take some out of the public market equity allocation, and that would boost your fixed income, the core fixed income allocation from option B up by 3.5%.
Hey, Josh, if I could, on the bank loans category, I see it's iShares floating rate ETFs. Is that an actively managed fund?
No, this is an index.
Okay, thank you.
There are actively managed funds. The entire implementation, to fast forward to the implementation is still 100% passive for the public market assets.
Thank you.
And then finally, option D, again, for illustrative purposes here. And I think if we highlight, a couple of stats at the bottom of the page, the return risk. So this would be your risk adjusted return. How much return are you getting for every unit of risk? Options B and C have slightly better return risk adjustments versus the current portfolio, with option D being, again, slightly more. If you wanted kind of the nuanced view of how much difference is this, the differences here are not substantial. And I think we'll see that in some of the stochastic outcomes that, the option C gets you slightly better outcomes in a number of scenarios, whereas option B and your current are maybe a bit more similar. You can see your probabilities of achieving 6.9%, marginally increasing. The drawdowns potentially getting a little bit worse just from higher volatility, higher return-seeking fixed income exposures, higher private equity exposure in option C, right? From a drawdown perspective, a 1-year max drawdown would be a bit worse.
Josh, I would say that to me, from reading this at home and now looking at it again, the biggest surprise is how low the percentage is over, again, obviously just projections, but how low the percentage of us achieving 6.9 or 5.9 is under the way you guys are modeling this.
Yeah, well, you can think of the expected return looks like more of a median outcome. It's so, the fact that they're just above 50% on all of these, certainly if the goal is to really increase that probability, you have to look at a much higher returning portfolio, take on a little bit more risk to increase kind of that median outcome.
No, I agree. I mean, there's no, again, no magic balls, no magic 8 balls, no, nothing you guys can do. I just think it's interesting. I must say, if I was sitting in the Board of Finance's seat rather than this seat, I'd have an interesting response to this. That's all. But it is what it is.
Yeah.
I mean,
there's some element, right? The 6.9% return is the target return, worked on with the actuary. Certainly that target return could be something lower. We've certainly seen that over the last 10 or 15 years in the public pension world that, go back to pre-global financial crisis, and most public pensions were using 8.5 or 9 as their discount rate and their expected return target. As returns come down, this is probably more of a reflection that long-term equity returns are not 10% anymore. They're, 7%. so the ability to way out earn that expected return has come down a fair bit, just because equity returns are probably a bit lower. The long-term equity expectations are a bit lower than they may have been, 10 years ago.
Yeah, I think all we're saying is that what we're not even going to touch tonight is whether or not the 6.9 is the right number. That's really what we're saying here for the future.
Yeah. And again, this is all market return. There's no active management assumed in any of these portfolios, obviously outside of the private market. So that's, not necessarily to be covered today, but maybe for a future or some sessions next year is to think about. That is one way to potentially increase returns in certain markets. So we'll be focusing on again, all passively implemented portfolios here. So another metric to think about these portfolios. So we think about return. They're expected to return. They're expected to hit the returns, a little bit over 50% of the time over the long term. Some of these max drawdowns, maybe we can contextualize that in terms of stress scenarios. So that's on 26. Thinking about, sorry, hold on a second.
26.
We've run three different types of stress scenarios here. Two of them are historical scenarios, so kind of reliving in early 2000s, 2008. And then the third scenario would be one that, based on our risk models, kind of has like a 1% likely outcome happening. This would be almost an instantaneous 20% drop in global equities, and rates also falling in conjunction with that, about 100 basis points. So again, thinking about how these portfolios do across all of these different stress scenarios, it shouldn't come as a surprise. Again, option A generally does worse in all of these portfolios, in all of these scenarios, just huge allocations to public equities, much smaller allocations to your core fixed income. You do see that options B and C, at least in the tech burst, perform a little bit better. But generally across the board, relative to the current, they do a bit better in both options B and C. What we've also added to this page is translating this to kind of, if you had to go to the Board of Finance and we experienced one of these, what actually happens to funded ratio and the impact to a contribution number in the next year. And you can see as things are generally smooth, the impacts are a bit smaller. Certainly the global financial crisis portfolios dropping 30% in a single year would be materially impactful. But a 10% drop in the portfolio doesn't automatically equate to $5 million more in contributions. And the difference across these portfolios, again, given the smoothing, is marginally different on a one-year basis. You can see the impact on contributions right between current option B and C, and the tech burst is, between option C and current is 0, and between option B and current is, 200,000 less in terms of an increase in contributions. So I think the big takeaway is options B and C may protect from an absolute return drop, but if we're thinking about the broader impact across funded ratio and contributions, these stress scenarios look kind of similar on a one-year, one-off basis.
Hey, I realize we're focusing on, or I've heard that we're focusing on B and C, but I don't see option D described in the stress scenarios. And one of the reasons I ask is that private infrastructure seems to be the elephant in the room that we're not talking about much, which is on a risk-adjusted basis, it looks like a screaming opportunity based on your capital markets forecast, which, as Ken said, is not a guarantee. But is there a reason we're not looking at option C volatility in this screen?
Yeah, so, we certainly think, option D, right, we brought, that's some of BlackRock's best thinking. I think part of our approach here was, I believe for infrastructure and private credit, the board would probably benefit from a bit more education. I don't know if that would necessarily be an option that would have been selected. Not to put the decision in your hands, just from our experience, I think there would probably need to be a bit more conversations with some infrastructure and private credit experts to get you all over the line there. I mean, I'm happy to send you all updated exhibits with option D included as well, if that is a potential for a decision. I think, Tom, you hit the nail on the head a bit, the risk-adjusted return from infrastructure, on top of just kind of the macro force and opportunity that we see in infrastructure from, data center build out, what is the future of energy and that the build out that's going to be required from there, that there's certainly a ton of opportunities for increased returns, and it's diversifying relative to a lot of the other assets that you have in the portfolio, would be generally additive, similar to real estate. I would think if you looked at, say, the tech bubble burst, for example, one of the reasons option B does better is that real estate allocation was pretty diversifying. And we would venture that infrastructure would be extremely diversifying in that sense too.
Well, I actually wondered about that because I see that BlackRock is very active, and this is anecdotal maybe, but in funding AI mods and whatnot. So I was wondering if actually in an infrastructure, in a tech burst, meltdown scenario, that option D actually would do poorly because much of it would be technology oriented. But maybe I'm guessing wrong.
I mean, Ray, happy to have you add some comments on what else BlackRock is getting into on the infrastructure side. It's more than just data center build outs. Certainly you probably saw at the beginning of the year, BlackRock's GIP group, participating in the potential purchase of the Panama Canal, right? Infrastructure includes things like airports, toll roads, tons of assets with long dated cash flows. I think the current investment theme is the fact that all of this AI build out requires tons of capital and capital investment, and it's all being funneled through infrastructure firms.
Yeah, I would just add that our latest fund that is being launched, launched actually today, AIP, it's called AI Partnership, and it's GIP, BlackRock with NVIDIA, xAI, Microsoft, and some energy partners as well, NextEra being one of them. And essentially investing in data centers as well as the power infrastructure needed to power those data centers. It's going to be about a $30 billion raise. There's already $12 billion just by those partners and GIP and BlackRock investing in there, the GPs investing in there, and then they're going to be raising private capital as well. You're seeing the hyperscalers spend incredible amounts of CapEx dollars on AI, which is all well and good, but at some point they're going to start to get pressure from the shareholders in terms of CapEx dollars and where they're spending them relative to what their business is, and so those private dollars are needed, and that's what we're going out to raise money for.
It sounds to me, I think Ray and Josh, you said it before. It's not inconceivable that within the umbrella of the alternatives that we have, that maybe this infrastructure or the private credit could be of interest to us as if we wanted to shuffle the menu around, so to speak. But I also think that, this is high level stuff that would definitely require, that was a very good, very brief description. We appreciate it, but obviously we would need to get your people from BlackRock in each of those areas to come in and really at least make me comfortable. Probably.
Yeah, of course. I know. What the focus is in terms of the capital needs out there for the AI side, which are to build out the data centers and the power needed to run those data centers. So those are the big themes.
Right. No, absolutely. But I think just going back to what Tom was saying is simply, I think for what we're doing tonight, I think we should be careful not to try to introduce whole new classes that nobody's familiar with.
That's fair.
Right. Only because we got a lot on our plate here. And
Yeah.
So.
Just to be clear, I'm just asking that we see the downside scenario for option D. I'm not suggesting or implying that that's something in the short term that would make sense. But I do feel a sense of responsibility, Ken, if you or I were in front of the Board of Finance and hypothetically this were being brought up, to be able to explain clearly and concisely why it is that option D is off the table. And I think the prominence of global infrastructure in the capital markets forecast just asks for an explanation. And if it's just a lack of education, fine. That's fine. But I'd like to see option D downside shown just so we've looked at it.
Makes perfect sense. No argument whatsoever. I had a second question, or a question. Josh, talk to us a bit, because I think this is really important, at least for me. In going through these stress scenarios, if we were to consider converting some of our bond exposure from core, which is one option, to what you're calling return seeking, what are you guys, within this chart here, how are you guys modeling things like high yield and corporates and whatever, how it performs in an equity meltdown, right? Because my experience from my career is that only treasuries hold up in fixed income when the markets really get the crap kicked out of it. And things like high yield and corporates get killed. Or it doesn't mean it will always happen, but it has always happened. So I'm curious about how that adds, I can see where it adds the potential for more return in normal markets, but I don't see how it helps us on a volatility smoothing basis, if that's what we're looking for.
Yeah, so talking about page 26, the kind of the stress scenario. So all of that is captured in, the Aladdin modeling that we do here. Certainly in most of these meltdowns, right, you think about high yield versus the investment grade credit exposure within the core bonds. High yield spreads expand much more widely than investment grade spreads tend to do in these meltdowns. In none of the portfolios do you have tons of long dated treasuries. That's part of the core bonds is kind of all fixed income, but long treasuries aren't a significant component of the treasury market today. So there's not a ton of duration protection. And, some of the stuff that we've seen, especially thinking about more near-term correlations, that longer bonds have been less protective, at least since COVID, than they were in the period before COVID. What we're finding is, certainly in the short duration market, while you don't get the duration play, that's kind of been a little bit more of the flight to safety. So, you're right that, reducing some of that core fixed income for a high yield bond might be a bit riskier here. What you do see is some of the international fixed income is a bit diversifying here. So that's like your emerging market debt. There's a lot more sovereign bonds. So you can think of these as emerging market treasuries, if you will. You have mostly developed market treasuries in your international core bond exposure. So adding the emerging market debt exposure, and that's hard currency. So it's US dollar denominated bonds. So there is some of that protection. There's a bit of duration in the emerging market debt part of the portfolio. So you do get some protection from that, and as well as kind of non-US diversification. Certainly a tech burst, or if you think about an AI burst, potentially could be more of a global contagion. But, you are getting a bit more diversified exposure from fixed income markets. Allocating there to these return-seeking fixed income, right? You're getting high yield, you're getting bank loans, are a bit more spread exposure. So there is that reaction, but that is all captured in all of these modelings. So part of the benefit that you're seeing in some of the lack of drawdown is dropping some of your equity allocation, is some of the primary benefit that you're seeing in that case. And some of it is that diversification of fixed income and having a little bit of that duration from the emerging market side.
Anybody else have any other questions at this point? Just stop for a second and digest.
I have one. Josh, for emerging market equities, is there a specific ETF that you're using to track that? I don't see one listed on here.
Yeah, so the current portfolio and the current implementation uses the global ex-US, so that is both developed and emerging in one fund. So we would propose that we keep it the same, given that it's passive and we keep it at market cap. You would just generate the same market cap return as what both developed and EM are getting in that one fund. So.
Okay, so there's no way to focus on that specifically if you did want to shift the allocation?
We could split out the equity into individual regions. So there is a way to implement passively US international developed and emerging markets. As it stands, again, we, with no active in the portfolio, and we also designed this where we would not necessarily take tactical bets regionally. Keeping the kind of condensed fund is a pretty efficient implementation part.
Okay.
Good question.
Yeah, and certainly, right, as this evolves, we can think about an SAA, we can think about active management, we can think about tactical management. If there was a desire from the board to implement any of that, we could keep an all passive implementation and have, regional equity tilting, for example, right? That would have paid off at the beginning of the year if you tilted a bit more into international from US. As we see, obviously it moves all the time. So we've been keeping market cap and using the funds that we have, which is an all US fund and the all international fund.
For the return seeking fixed income, let's say that there's like a sharp equity market drawdown. These have, some credit exposure to them. They draw down as well. How do you expect the rebound to behave with respect to equities? So equity market sells off. We've had multiple times in the last 5, 6, 7 years. Equities can quickly rebound back to 100%. How do these other asset classes kind of behave on the recovery, kind of with respect to S&P or equities?
Yeah.
But what's that behavior like?
Yeah. So the drawdowns are generally less dramatic than equities. Obviously, with spreads still blowing out, there's obviously the drawdown risk. Usually what we've seen, at least in the last couple of market drawdowns, we can think of COVID, we can think of even global financial crisis, is that, short periods after these significant drawdowns, when there's a bit of market stability, the spreads tend to tighten back up, generally correlated with when equity markets recover. So it's not like equity markets recover in 6 months and it takes these high yield spreads to come condense. It takes 12 months. It's generally kind of in line with when equity markets recover. And since the drawdown was not as wide, the return pickup is not as big. So you're not going to see like a minus 20% drawdown and then a 30% pickup. It'll be, 11% drawdown and 9% pickup or something like that. So it's not as dramatic in terms of the drawdowns. So that's generally what we've seen. Yeah.
In situations where there's a drawdown that has significant defaults and debt's written off, in that type of situation, are they much slower to recover, as you actually have impairment of capital potentially? I'm just trying to.
Yeah. I mean, certainly the recovery rate on much lower quality fixed income is worse. One of the things that you see is much different between, say, 2008 and where we are today is the level of triple Cs, like the really low quality issuers, is significantly lower within the index today than it was 15 years ago. So, if recovery rates or default rates, back in the financial crisis may have been 8 or 10%, they'd be closer to 3 or 4% now. So in terms of the full loss, it's a much smaller likelihood now, just given the higher quality. It's a lot more double B and single B names within the high yield index. And so that kind of default risk is a lot lower. But that's certainly one of the risks of high yield. It's one of the risks of investment grade. It's just the default risk of investment grade is, generally substantially lower, right? That's why they get the investment grade stamp versus non-investment grade stamp.
Yeah.
But
and then in the floating rate bank loans, can you just real quickly cover what type of loans are typically in that type of index?
Yeah, so these are, the bank loans index is generally considered investment grade, but there's some sub-investment grade that's also included in there. And these are issuers that don't go to the public market debt, they go directly to banks. And that's been a much bigger part of the debt issuance market since the global financial crisis. So we've seen the size of issuers going direct to market via banks rather than via, debt underwriters, just increase more over the last 15 years. So it's just a much deeper market now. So while it's consider, it's in that return seeking fixed income. It's not necessarily a sub investment grade per se. A number of the issuers, if they went to, a debt underwriter and got their debt, underwritten by Moody's or S&P, would be investment grade. They're just going through banks, and the type of debt that banks tend to issue is more floating rate, so quarterly reset of coupons rather than kind of a set fixed rate that you would see in a high yield market.
Thank you.
In terms of,
Actually, no, I lied. I have one more question. On the capital market assumptions, we have our private real estate portfolio that's with one manager. You guys have your own expected annualized return, roughly 6%, vol 12. Do we know how that compares to Principal's expected annualized return and volatility for their specific portfolio?
I'll have to pull one of their more recent. I don't have off the top of my head their kind of what their general expected return is, and I can check with our manager research team if we have kind of a expectation of what their return would be. Over the longer term horizon, I believe that their performance has been around here, maybe slightly above the last couple of years, notwithstanding. A good chunk of private real estate return is income oriented, and that supports some of the return in the core market. It's just the kind of non-income part of the return is at least been pretty decimated over the last couple of years, and so there's certainly opportunity. We've seen, from our valuation and expectation in CMAs that this expectation has come up over the last 2 or 3 years, but that's a lot driven by how low valuations are in the private real estate market. And there's other ways to access, that's another consideration that we did not model here, but Principal is generally the portfolio they have is what we would call core or core plus. It's, looking at the general core real estate market, the 4 quadrants, if you will, of residential and, retail and office space. There's a kind of a subsector of real estate called value add real estate that tries to, it's not going to generally be in the same exact sectors, but the idea is that you can generally create better improvements of properties and generate a higher excess return. So there's ways that you could generate potentially higher return than kind of the 6% in the core real estate market if you went with more value add. But that, would require thinking about implementing a different manager. And we could certainly provide some education on that as well. Um, 27 is kind of the summary. It might be, interesting to look at tables first, then come back to our summary. I thought that this would be a good summary for people to take away and read. So maybe we'll think about 28 first, because I think the takeaways that I mentioned, again, this is a very colorful, lines are all on top of each other chart. But I think the real key takeaways kind of are threefold, notwithstanding the bullets at the bottom. But after 5 years, the assets, the NAV in the portfolios between all of the options besides option A are relatively similar. This is where I mentioned that in the near term, current portfolio is doing its job. These options may provide a bit more balance in drawdowns. They might provide a bit more upside potential. But typically, if you look around the median, the difference is not very large. Where we start to see that compound is over time from slightly higher returns. And what we see from a NAV perspective, downside outcomes across these options are all relatively similar. A lot of that is because when there's drawdowns in the markets, your required contribution goes up. So there's kind of a floor to assets overall, and that's driven, we'll look at that on the next page. It will be driven by upside to contributions. So the floors are all relatively the same. And so what you really want to think about is there better upside potential, ways that we can achieve fully funded, reduce contributions more quickly over time? And we do see that options B and C, over 10 years, little bit better than the current portfolio, and over 20 years, significantly better, especially with option C. And that's probably more of the positive outlook on a private equity asset that has a significantly higher return. And if you catch the upside there, having that slightly higher private equity allocation could generate significant upside. In terms of the,
Josh, quick question on principal, just while we're on that. Is there much color on redemption requests for 2025 so far?
we have I have not gotten the most recent statement, but we can reach out to principal and see how their redemption queue is going. I think when we talked to them last year, right, they had a pretty big line, but they were trying to make some investments. We've seen investments pick up, so there's a chance that liquidity for them has picked up. But I would say that we're probably more constructive on real estate prospectively than we have kind of over the last 12 or 24 months. So may still be that same response that that there's still that queue, but we'll check in on that.
Yeah, well, I know the size of their queue has fluctuated pretty materially to several hundred million versus a lot less than that. So just curious.
Yeah, that's right. And again, I think that there's some more positive outlooks coming out on the real estate market. You're seeing some stabilization in the commercial real estate market. Cap rates have settled, so there's a bit more clarity on kind of the path forward for investments that you may not be seeing as much of a run up for redemptions. But we'll follow up with principal on that.
So understanding that this is a roadmap, 10,000-foot view, we're not making any immediate decisions, what would the plan be to move out of principal? And how would we roadmap that? Just for
Yeah. So certainly we'd keep
Get one.
Yeah. So if we were to move out of principal from an SAA decision, right, you're moving to option C, for example, we would put in an immediate redemption for principal. We suspect that it would take a couple of quarters to get all of the money back that you have invested. But you also would not be making an immediate contribution into the private equity, right? That takes time to pace out. And so you'd be able to kind of time drawing down the real estate in terms of making future commitments to the private equity side. If you were to pick option A, the all liquid, right, and kind of withdraw all the way there,
yes.
we would end up with kind of a day one portfolio. You're still invested, and kind of targets along the way of drawing down based on what we can expect to receive from the manager. And so we'd be, managing the portfolio, thinking about not having 100% of the real estate redeemed for several quarters. And so you'd kind of be operating slightly off your SAA targets, which is why we'd have bands,
Right.
and we'd benchmark appropriately around kind of what does the portfolio look like and what are we trying to get to eventually.
And is it a discussion with your manager research about where we would allocate?
Well, if we were completely redeeming from real estate, no.
No, sorry.
But if you were
going into private equity, wasn't option C moved from real estate into private equity?
Oh, in option C. Yeah, I mean, so we have our private equity colleagues that were here that would help us understand kind of where the right place to make investments are, whether that's primaries, secondaries, co-investments.
I don't ask you to speak for them right now. I just wanted to understand how that would work.
Yeah, exactly. And we would intend, regardless of if there's a portfolio change or not today or in December, right, running at the beginning of next year a pacing study to kind of understand where you are in terms of the target NAVs that we have and what types of commitments the board would need to make in the future just to kind of maintain that target allocation. Potential that it's zero depending on how the assets move. Potential that there would be a commitment needed for next year, and we could figure out which type of private equity investment, primary, secondaries, co's, that fits within the current programs that you have.
And we may have even more time for it based on the amount of redemptions,
Right.
I guess. So we'll know more when we know more.
Yeah, exactly. And in terms of kind of the other analytic to kind of come back to some of this analysis here on page 29, thinking about contributions. So we looked at assets, the dispersion. I think if we look at contributions, again, it's the same thing. The point being, there's lots of smoothing. You're thinking about long-term investing, and at least the near term, kind of the red text correlating to the red boxes at the bottom. There's not, between these portfolios over the next 5 years, you're not expecting to see significant differences in terms of outcomes from a contribution perspective. You might be a bit better funded, but again, the smoothing of all of these numbers and the actuarial numbers means that you're not going to see a significant deviation. Where you start to see that build up happens over time. And again, this is the longer term expected return. So where you see a higher expected return, especially in option C, over time that draws out in terms of lower contributions. Again, on the downside, if you're under earning that 6.9%, you're going to be in a similar bucket across portfolios, especially that 10th percentile. That's kind of your worst outcomes in terms of assets. I'm sorry, that would be the other way. The 10th percentile is the best outcomes. This is if you just completely beat 6.9%. There's not going to be much difference in terms of your contributions. Like upside is upside, and if all of your portfolios are generating strong returns, that's great. But if you can at least out earn some of the other portfolios, in kind of downsides, I think some of the faster growth from options B and C help offset some downturns. So you see that 75th and 90th percentile contribution outcomes, option C a bit lower than you would get from your current or your option B. And you see that play out over longer terms. Again, if you look at the charts, the magnitude of impact, not super substantial here. But again, it is numbers. Looking at the 10-year 75th percentile, the difference between current and option C is $5 million. That's $500,000 a year. So to put dollar figures on that. And so maybe if we turn back to 27, just kind of summarizes all of this. I highlight green outcomes are good. So in terms of NAV or funded ratio on a median outcome, kind of the expected outcomes, both option B and C produce better outcomes than the current portfolio. How material? Look at your funded ratio in 10 years between your current and your option B being 0.4%. That might not be material enough to make a decision to move. With option C, it's 3%. That might be more of a motivating factor to make a decision to shift. After 20 years, if you're 119% funded versus 120% funded, you're overfunded, you're covering all of your benefits. It might not make much of a difference. But one of the big differences is how you get there. And so even if the ending kind of NAV and funded status result is similar, if you look at contribution size, it might cost you a little bit less from cumulative contributions to get you there. That's the levers you have to play with here, is increasing return versus increasing, pay for versus not. And kind of the expectation with higher expected return outcomes is lowering contributions kind of in the middle of your outcome scenarios. I think there's a lot to, digest. There's a lot of ways and metrics to think through all of this. I think if you, again, go back to our return target, can we hit the return target? What is the risk to missing that return target, or how likely to consistently miss that return target? And is that going to be in an area where we're going to see much more elevated costs? And, at that 75th percentile contribution, that would be a scenario where, you've been under earning the expected return by, maybe 100 basis points. And you could see that the likelihood is that your return will still be a bit better with option C, and the total cost of that is a bit lower.
Like Josh said, it was a lot to digest, so
It really is.
it's okay to come back and ask questions.
Yeah. And we've all been put into a food candy coma by Eric as well. George, anything over there? You've been suffering in silence with your injury.
The real estate has bothered me since our first meeting I attended.
You didn't like learning about individual buildings?
Yeah, I didn't think that we should be reviewing investments in a Minneapolis office building, to be honest. So any exit from that would be something I would think would be a priority.
Okay.
As we redo the portfolio.
Well, my instinct is that nobody appeared thrilled with Principal when they were here. Not because I think any of us really know whether or not they're good or bad at what they do, but I think that, like you said, the way that they presented us the granular information, I think almost put pressure on us in a way that was uncomfortable, since we have no way to even talk about it. And I didn't get the feeling that BlackRock or anybody loved them. Does anybody here feel differently? I mean, not everybody was here necessarily, now that I think about it, but you weren't here. Josh, would you say, that, as long as it's been brought up, that Principal is a weak link in our portfolio?
I mean, I think, they're representative of kind of core real estate in general. It's been an extremely tough environment. I think, one of my takeaways from the last time that they were here was their emphasis on investing in a data center, and part of their kind of investment process and redemption process, right? That was a question on the queue, was they're looking to invest in this and they're spending their capital there rather than helping redeem. And that's one asset. And I think there's other potential managers that have a different approach to the real estate market. I think that there's certainly opportunities, as, like I said, I think cap rates have started to stabilize, the vision forward. If real estate stays in the portfolio, we certainly have other options from a manager perspective that could fill that role. I brought up the idea of value add, which has, similar characteristics, but focuses on higher return opportunity properties. So you potentially generate higher returns than kind of what core real estate tends to do. As a whole, it does offer ballast in the past, right? It's an inflation sensitive asset. It has kind of long tail, thinks about kind of long-term investment, and it tends to be diversifying. But there's other avenues to get that. One idea is potentially investigating infrastructure as a replacement as an asset class overall for real estate. So there's a lot of ways that you can go with that, but certainly there are other managers from Principal to be considered.
Can I tell you one thing that's been sticking at me a little bit, and I want to just bring it out? On one hand, you guys talk about the long-term nature of of what we're trying to do here, right? I think we could all agree that is a almost in a world without much fact, that's pretty close to fact, right? We are managing against liabilities that go on indefinitely, I guess. And then what I'm hearing, and it's not to pick on you, please don't take it that way, is trendy stuff, right? So 2 years ago, nobody would have said boo about the things you're talking about right now. AI, data centers, energy, all this stuff that is related to AI. There's been $1,200 billion trillion thrown at this thing. You could easily say this is the biggest bubble in the history of mankind, right? Easily could say that, or is going to be, actually. Or maybe not, I don't know. But what I'm just a little concerned about is that if we really are looking at something that isn't going to be, I'm not saying any of these things don't belong in the portfolio, don't get me wrong. But I think they belong in the portfolio in what am I looking for? In an umbrella basis, right? In other words, I don't really like the idea of saying we're going to have an infrastructure asset class, right? That's just my opinion. I think that infrastructure belongs under some asset class, right? But it's just something, if it's something I never heard of 2 years ago, it kind of scares me in something that's going to be an indefinite investment, that all of a sudden we're running after it.
I'll go ahead and say infrastructure has been its own asset class for.
No, of course. I'm talking about this AI related boom.
It's usually under real assets.
I'm sorry?
It's usually under real assets, includes real estate and infrastructure in generally. That's how it's been in the past.
No, that's exactly what I'm saying.
Yeah,
Don't get me wrong. I'm just talking about, every firm, including BlackRock, is raising a $50 trillion fund now to do this and that. And so
I mean, but in an infrastructure fund, it's not just an AI infrastructure investment that we would be making. Like that one specific fund that he mentioned, a ton of it was going into AI, and that was, but I imagine that if we have
Well, that's what I was
private
responding.
infrastructure.
Right, that's a very concentrated one in terms of what it's invested in. There are more diversified infrastructure funds out there.
Yeah.
Yeah, there are a number of institutional investors, right? To Nick's point, this has been an asset class that's been around. Ray mentioned it's generally considered or listed in IPSs as real assets. And it would just be a diversifier, right? You would look at, I have this infrastructure investments that we've made in the past. What am I missing to complete the picture here? Would be a more concentrated fund. There's plenty of core infrastructure funds that invest in harbors and airports and kind of the physical infrastructure assets out there, and their fundraising.
Which is what I was saying I'd be more comfortable with. Maybe I misunderstood you guys.
Yeah.
I got the feeling we were being steered towards something like what.
No. I was just telling you what some of the things we're focusing on.
Okay, I'm sorry, I misunderstood.
Probably gonna get like a toll road in that private infrastructure someplace.
Strong cash flow, strong extended cash flows.
Very illustrated. When you can plug in, you could just cover your hand with the names on the left-hand side, and you'll see the expected return and the volatility. And you could see the different asset classes, alternatives.
Right.
You know, there's some real volatility in private equity, right? There's a real volatility in private infrastructure. We're talking about slide 42, Josh. Because we're having this discussion about alternatives and your market assumptions.
Yep. Yeah, the volatilities. I mean, the illustration of these capital market assumptions are on page, I think, 7 to see that pictorially. But you're right. I mean, infrastructure does have a high assumed volatility. What's not listed here is correlations. So what we typically see is, the correlation of infrastructure, similar to real estate, is relatively low, especially to the equities in the portfolio. So kind of thinking about building out a well-rounded kind of growthy portfolio, which is higher equity allocations, allocating to private equity, infrastructure and real estate do tend, from a kind of total portfolio volatility perspective, kind of dampen that because they're generally uncorrelated to those assets, right? Think back to the tech bubble when everything went down, something like real estate went up. And so that helps dampen some of the total portfolio volatility.
Was there a correlation chart in here or no?
A few more years it went up.
I don't think that we included that, but we can send that around, correlations, from our CMA port. CMA.
Yeah, that'd be helpful. Thank you.
At the end of the day, let me just not sum up, but what we're trying to do here is I think we have conflicting goals or conflicting missions, I should say, because I've been doing this a while. Eric has been doing it for a while, even longer than I have, I think, on this board. Everybody here has been involved in the markets one way or another, I think, sitting around the table. On one hand, we have a mission to try to find some sort of risk-adjusted portfolio that achieves a goal, which is not just simply expressed as 6.9%. That happens to be a number that we've come up with. It's to try and get I'll call it a decent long-term return with a level of volatility that we can live with. And the problem that I've experienced is that it's very easy to say we have a 20, 30, 40, 50, 100-year horizon. And if we truly had that horizon, truly had it, then we would have a very easy decision, because even I would not be here arguing that, these volatilities won't work out over time. The problem is, and I've seen it over and over again, is that as soon as the market's at a rough patch, everybody panics. Board of Finance panics. I've been involved with this board, it's panicked. And the town, of course, has to, if we have enough bad years and it overcomes the smoothing, then it becomes a tax issue because there has to be increased contributions to the, in order to fulfill our goal here to try to be fully funded. So I'm not actually saying anything here that nobody understands, but what I am saying though is that I just wish there was a way we could close our eyes and really understand how we're going to feel. It's not just academic, is my point. When the markets take a tumble, and we're due for one, I don't know when, but we are due, how are we going to respond? How's the town going to respond? How's the Board of Finance going to respond? A. And maybe it doesn't even matter, by the way. Maybe that's just noise and there's nothing we can do about that. But when we introduce assets in other words, George and I spoke on the phone during the week, and he said, well, you know, why don't we just pick all private equity, right? It's got the highest return that these guys are projecting over time. And since we're a long-term vehicle, we don't care about volatility. I know it's not true. Why don't we just do that? Obviously, no, we're not doing that. So then how do we back up and come up with a portfolio that blends all these different asset classes, many of them that we know are not going to be high-performing classes, right? We're going to have some treasuries in here one way or another, right? Those are among the lowest returning assets, but they have a purpose, right? They have a volatility damping purpose. They perform differently than other things do when markets are going badly, et cetera, et cetera. And, you know, we have three options in front of us. And on one hand, that's three options out of a trillion that could be produced. On the other hand, we've hired BlackRock because we're very confident in their abilities to do all this work behind the scenes for us and bring us a couple of choices that make some sense. But I will go back to what Josh, I think, very fairly said. There would be nothing wrong with us doing nothing. I'm not saying we should, but our portfolio is by and large pretty similar to the ones that we're looking at. By and large, option C might offer some benefits. But like you said, it's projected by your models to achieve the 6.9%, right, that we're aiming for. So I just point that out, that everybody here probably thinks we got to do something. We don't necessarily have to do anything, although we might choose to.
No, but I think, you know, you talk about the time frame. You know, we do need to look at this on a long-term basis. And, you know, regardless of short-term, long-term, there's going to be uncertainty. We can't manage that. And I think we have a portfolio that really kind of balances the risk. And as long as you have, you know, sort of a balanced portfolio over the long term, I think just in a very simplistic way, that's, you know, that's what you kind of live with. You know, I think this kind of accomplishes what we're trying to do.
Well, this being what?
B and C.
Oh, okay.
Those options.
Okay,
And again, A does it too.
right. So A, is A current?
Current portfolio.
Yeah, A is the current portfolio.
No, is it? Oh, I'm sorry.
And,
That's what A was. Oh, no, A is the all liquid, right?
You know what I mean?
Yeah, you know, it's current.
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 Portfolio,
Yeah,
yeah.
current, right.
So,
I mean, it's basically right-hand tail risk of like, what are we going here? But
Exactly.
I do appreciate where you showed kind of like the delta of like the funding contributions. And I think that's like, right, we're not a short-term investor, but from the town standpoint,
Yeah.
we're both long-term and we're medium-term. Like, as you said, if we're impaired for 5 years in a row and the smoothing wears out, and all of a sudden we have to really up those contributions, and that is painful. But as long as it's not too long of a.
One thing I gotta say is that we've weathered the dot-com bubble, the Madoff debacle, a global pandemic, terrorist attack, we're still here. I mean, who's gonna throw at us? We've been resilient, both the markets
and you're gonna have another
Pension
hit
board.
at some point.
and the pension board.
Yeah, so what you're saying, which is definitely true,
What's
is
coming
two
next?
things. One, without question, diversification pays off, right? And I think that's been proven by a billion models. But I will point out, not to be a negative, whatever, think of some negative Nelly or something. All of us have lived through a very unique period of time. All of us have come of age, and the markets have basically simply recovered from big drops. There have been periods of time in the past when that doesn't happen. just pointing out, markets after the Depression, it took about 40 years to recover back where they were. From the mid-60s to the early 80s, basically, was flat.
2000 was just a bad decade.
Well, that recovered reasonably. Well, it depends what sector, right? Again, but Tom, you said it best, actually. Pointing that out is not really helpful because we have a job to do, which is to invest this money. I really was only discussing,
Yeah, I know, that's-
I was just discussing whether or not we want to introduce more alternatives. That's really my,
My mind is simple.
What I will say about those comparisons of like these like flat decades and all that stuff, it took this long to recover. Well, we're not just a completely passive, put our hands in our pocket investor, is that we continue to make town contributions every year. So even when it's depressed, we are still investing new capital at these lower AUM levels. And so when it does recover, you do get back to whole faster than that time period and you get to invest in impaired assets, even though you don't love it. So, you know, people that look at, oh, there was a lost decade. Well, if you just didn't invest anything, then yeah, it was a lost decade. But, you know, I have friends that are like, oh, I don't like to look at my 401k on like the downtime. I'm like, put more money in. Like, that's the time. Like, it's, you know, these things happen, but it's not like.
well, the one
always like
advantage, I'll tell you, it's a good point, Nick.
Money in.
It's a good point. It is a good point because our fund is different than an individual investor's fund in many ways. And that's a very important point because an individual can choose to just put their head in the sand and not invest and pretend the world's coming to an end and not open their statements. We don't really have that luxury. So as you're right, as money comes in through town contributions, we will be investing it. So that's a help too.
I'm saying that those people that do that are wrong.
Have been wrong. One of the things I've always pledged, the only thing I've pledged as chair is to try and not let these meetings go all night. And we, to some of you guys who weren't involved in the police and fire executive, we made you guys sit around. I personally do not think we need to make any votes tonight. That's my opinion. I think we've got a lot on our plate here, a lot of information, a lot of stuff to chew over. Plus, it's not like we have a portfolio that's 100% in cash, right? We have a portfolio that is by and large pretty similar to whatever we're going to end up changing. We're talking about some tweaks around the edges, certainly for now, even if option D became something we wanted to talk about, it's certainly not tonight's business. So I would recommend that unless there's any more questions, I'm not stopping the meeting. If there's any more questions here on this topic, and you can do that, that we consider, we don't have to do anything, by the way, but consider voting at our next meeting, which is what, December?
Yes.
You know, in terms of any changes we want to make. That's the only suggestion I'm going to throw out there. But Joe, what do you got?
Just two quick questions. One, back to principal, just to bring us back to earth, I guess.
Yeah.
I agree though. We're not like we're looking to take a 10 to 15% haircut on anything, but I would be curious to know if there is any secondaries volume there, or if that's even permissible in principle, just because everyone's talking about secondaries, and I'd be curious to know if there's any volume there.
The Principals Fund, it's a closed-end fund, so trades, it's not exactly like a mutual fund, but it's not like you find buyer on the secondary market generally. This is you put in your redemption and then they will liquidate you for cash. There's
Right. Well, I just know I've heard a little bit about liquidity trying to be made on like NASDAQ for certain closed-end products lately. I don't know if that's real or not, but I guess if you're hearing no, then that answers my question.
Can I ask you one question to piggyback on Joe here? Because I don't know anything about this topic. So you mentioned that you were disappointed, Josh, that when they presented to us, they had this huge list of people who were looking to get out, and yet they're making new investments. Is that a feature of this fund or of all funds? Meaning, it seems to me that if people want out, that should take precedence over making new investments. You would think they would honor the redemption request to the extent they can, and then when they're flat or money's coming in, they make new investments. Doesn't that seem like A, what should be the way it's done.
Yeah.
And B, any fund, private fund that we would choose to potentially go into, I would think that would be the structure I would want if it is available. Or, does that make some sense?
Gates or something, they may not.
Well, it's not the gates I'm interested in as much as the, in other words, to me, when you think about it, let's say a fund has X dollars in it, and then 10% more comes in, well, then they should make more investments. But if 10% of the fund is lined up to get out, and they say, well, no, you can't get out because we're using that money to buy new investments.
Sometimes they're weighing that against, like, so either making giving the money for a redemption versus investing in the current portfolio where there's needs, capital needs that they're like some of their portfolio companies that they have in there, or real estate investments in this case, need some more investment. And you got to kind of balance that because you don't want to hurt the performance of the portfolio overall versus the redemptions. And that's the balance they got to play.
Yeah.
You can't favor the redeemer.
Yeah, I hear you. No, as you're saying it, I realize that, yeah. So, I mean, okay, well, let's not dwell on.
Josh, tell me if you disagree on anything, but that's.
No, that was going to be basically my answer. Yeah.
And just final question, can you triple confirm for us that Fairfield's total compensation to BlackRock doesn't change based on which SAA we target?
That is a good question. So we charge you an OCIO overlay fee, and that fee is fixed. That's 5 basis points.
Right.
We do charge for the underlying products. You currently pay 2.5 basis points. For options B and C, that would be 3.5 basis points. So 1 basis point change. Or 0.00. Sorry, I don't have my decimals. 0.01%.
1 basis point.
1 basis point would be the change in fees.
From which to which again?
So your current portfolio, there's the 5 basis point OCIO fee on all assets. And then you get charged 2.5 basis points on the public market assets that BlackRock manages. Under options B and C, that 2.5 would change to 3.5.
Is that change from 2.5 to 3.5, including the fees on the iShares, like the BlackRock fund version?
That's what drives it. The return-seeking fixed income funds are generally a bit more expensive than the core bond funds.
Yeah.
The core bond funds are 3 and 7 basis points ish each. The return-seeking fixed income funds are closer to like 12 or so.
Okay. Thank you.
I understand. Yeah. Okay.
Yeah, the 5 basis point fee is not changing.
Right. I mean, it's something to be considered, but we'll talk about that. I mean, it's real money. It adds up. But if we're choosing something because we think it's going to be a better performer, then that 1 basis point is something we have to factor in. It's just part of the story. Okay. Any other questions from the table or from Tom, if he's still on?
Not for me.
Okay.
What are we expecting in December then? We said put off a vote on what portfolio, but are we looking for BlackRock to provide us anything else on any specific items that we would be interested in seeing?
I think I guess around the table, we could certainly, that's why I was asking if anybody else has any other questions that they want them to come back to us with. I mean, on one hand, it's a lot to digest. On the other hand, it's somewhat straightforward in terms of, first of all, let me just say one other thing, not to make this more complicated. There's no law that says option B or C is our end result here, right? I mean, it like I said to start, BlackRock doesn't have a crystal ball, nor does anyone, but we hired them for a purpose. They do have, deep capital markets experience with, I guess, educated guesswork on future returns and volatilities. And at some point, I do think one of the reasons we have an OCIO is that we have to kind of allow them to bring us a menu, and then we have to work from that menu, right? Or else it could be an endless, right? We would have no way to end the discussion, because the choices are infinite out in the universe.
The only timing constraint would be anything that Millman needs to do their run-up, right? So Millman's report typically comes, the actuary,
Right.
right, January, because we
Right.
want to get that way ahead of the budgetary cycle.
Oh, we moved it, right.
So, Millman's gonna want something locked in.
I mean, for
They
their,
have two runs, yeah, because
I mean, for their forecast,
Yeah,
right.
yeah. I mean,
I would kind of generally guide there that they'll use your long-term expected return. So what they look for generally is that the portfolio supports that discount rate. So if you were increasing the expected return, there would not necessarily need to be a change. If you were decreasing the expected return, they may want you to consider not 6.9, but something lower. So I would suspect if you
Yeah, I
showed
think
them a
honestly-
portfolio you're considering, they run it through their capital market.
I was just gonna say, assuming they agree with you or close enough, then you're probably right. So you're right, okay.
Yeah.
I mean, I'll throw this out at the table because this is a democracy. Nothing stops someone from making a motion of any sort that they like. I just don't feel like I hear anybody itching to do that. Okay, I'll take that as
Yeah.
no.
Nothing is like jumping up at me. It's like, we need to make a change and make it now. Feel like we have to look at these numbers longer and, going from current to B, you get, 10 bips of return. Sure, you go to C, you get 40 bips of expected return, but like, what's the, kind of like the, shadow price of some of these capital market assumptions if they're off by, 15, 20 bips in an asset class, what does that do long term?
I mean, I think also what everybody needs to digest, in my opinion, there's two things really, I think. One is that traditionally, correct me if I'm wrong, Josh, we've been an ag bond consumer, and we're discussing whether or not we want to branch out to a higher return seeking, higher volatility bond options, right? Which is perfectly reasonable to be talking about. And then the other question is I guess, I don't hear much appetite for increasing the alternatives, but I do hear an appetite for possibly changing the components of our alternatives. So I think if I don't know who asked the question, like, what are we trying to go home and think about a little bit? That's what I would be thinking about, those two topics.
Yeah, if I could on that point, Ken, if we could maybe break this down into issues. So for example, if hypothetically Josh said to us, how do you feel about increasing private equity, being at the 10% level, being at the 15% level? If hypothetically the board says, well, we can't imagine going to 15%, all of a sudden I think the decision-making here gets a little simpler, or at least the general direction gets a little simpler. And the other issue is what I've heard repeatedly, which is that people aren't thrilled with U.S. real estate. So hypothetically, if everybody says, if there's a consensus rather, that U.S. real estate is not a comfortable place to be, that again narrows the decision down a bit. So I think right now the issue, in my opinion, I'm speaking only for myself, is that we have two very broad decisions, recommendations rather, to consider, and we as a group haven't really crystallized our thinking on any of the sub decisions. So I think coming to a high level decision gets a little bit more difficult. So if I could, an immediate stage decision might be, are we in agreement on a couple of these elephant in the room points or not? And if we aren't, then we need to get there. But if we are, then I think we might be comfortable. I would say we might be comfortable proceeding in December.
I think, one thing that we can take away is if there's, questions or desire for more information, like you can funnel questions through Calvin in the interim, and we can provide additional information, over email to everyone on the JRIB. We can bring it to the next meeting if, to Tom's point, it's some of that high level thought process going back and forth.
Yeah, I think that's excellent. I think the only thing that I would maybe ask you now, to save the time of asking Calvin, from listening to everybody at the table, would it be worthwhile to just check in on principle what the status is of the redemption story? just so we have a little more information as to what options we may or may not have with that fund. It seems like a lot of people are not necessarily thrilled with it. So I'd just be curious if they came back and said, oh, things are great, all of a sudden, we're able to cash you out tomorrow. That won't be the case. Or, it's a 3-year process or somewhere in between. So it might be worth finding out a little bit on that score as one question for either you could let us know through Calvin as soon as you find out or at the next meeting.
Yeah, we can reach out to principal and so we could set up some time in BlackRock and get in touch with them.
Mm-hmm. Does anybody else have any specific questions they'd like to leave these guys with? Or if you come up with anything, just funnel it through Calvin? Okay, we intentionally didn't dwell on the OPEB because, it's a pretty similar story. And I think once we make a decision on one, we'll sort of have made a decision on both. So I think we can just leave OPEB to the side for the time being.
Actually, if there's any materials with respect to that real estate fund to read, if there's an offering doc or something or whatever, the disclosure, that would be great.
Carol,
to see.
were you able to hear that, Josh?
Yeah. We'll make sure we get. Not sure if we'll get the 9:30 update quite yet. It'll probably come out in early November, but we can get you kind of all of the materials that they generally do for their quarterlies.
Okay. One just housekeeping thing, by the way, that I took the liberty to do. So every quarter, the chair, if he's around, I haven't been, the last one Tom did for me, makes a report to the Board of Finance and then annually to the RTM. And the Board of Finance meetings can become a little bit contentious, and often because the members, I think, feel a need to ask a lot of questions, maybe for the sake of it, and it gets way beyond just the performance. So our next quarterly for the Board of Finance, I believe, is November 18th. And I asked Josh if he'd be willing to come to that meeting with me. And no, really, I think it'd be, I actually think it would be extremely helpful to let the Board of Finance meet our representative from BlackRock. And also, I'd be very honest, the questions come firing at me and it's half the time I can't answer them. They're technical questions or accounting questions, and it's not my expertise. So luckily, he is going to be, and it doesn't matter, he's available and offered to do that. I told him I would buy him one of those Haven hot chicken sandwiches or something before the meeting. So just letting you guys know that that was something we're going to try to do at the November meeting, and maybe once a year if we can. Unless anybody here thinks that could become a disaster on Sunday, I don't think it
Let's
could.
get that fee schedule
Yeah.
before he does that.
And Board of Finance meetings go, we might scare him away.
Yeah, exactly, right. So anyway.
It'll be a new board, so.
And it'll be a new board, which is perfect too. So anyway, just a small thing. Do we have any?
Old business, we have board protection.
Yes, thank you. So, Josh and Ray, thank you very much. You guys put a lot of work into all this, and you also sat around while we dilly-dallied upstairs, so thank you very much. Of course, you are out there in sunny California when we're here, so.
It is no longer sunny out.
Right. So you guys are free to try, if you don't want to hold you.
Thank you all.
All right, thank you all, and
Have a great
Ken,
night.
we'll be in touch about the 18th.
Yes, definitely. And thanks again, I appreciate it.
Thank you. Bye.
Take care, everyone.
So, Tom is still on? Tom?
Tom is still on.
Okay, so I appreciate it very much. Tom has been a real thorn in the side, appropriately, to try and get everyone on the board a little better understanding of the insurance and, I'm talking about the liability insurance for board members, and also state statutes and town charter, whatever types of protections that we have as board members. So Phil Piers we produced a little memo that I think we can pass around that has some information on it. There's nothing secret, actually. But I don't think it's necessarily a topic we need to go around speaking about more than necessary. So this is really for everybody's internal purposes, and I appreciate it. And Tom, I really do appreciate the fact that you kept on us to get this done.
My wife keeps on saying she doesn't want us to lose our house over an uncompensated board position, so
Yeah.
there you go.
Even a compensated one might not be so good to lose the house.
Oh, that's good clarification, Ken,
Yeah.
thank you.
So anyhow, this, I think there's stuff in here that should make people comfortable, but if you have any additional questions, funnel them back to Calvin and we'll get them to Tom Harris and he'll talk to Phil and we'll get you more answers. But hopefully this is something that gives people a little bit of comfort.
Thanks.
Thank you.
No problem, thank you. That was old business. Is there any new business? Okay. If there's no new business, then I think the only business left is asking if someone wants to make a motion to adjourn.
Motion?
Okay, you got right here. Second, Christine. All in favor?
Aye.
Thank you, everybody.
Thank you.